Okay, thank you so much everyone for coming to my talk. Today I'm going to be presenting a paper of mine called How Does Legislators' Personal Exposure to Financial Fraud Affect Support for Financial Regulation? So this is co-authored work with June Nguyen from the Federal Reserve Bank of Richmond and Anish Raghunandan from the Yale School of Management. And I just have to make a quick disclaimer before I begin. The views in the presentation belong to us, the authors, and not the Federal Reserve. All right, so in this paper, we're interested in understanding how might personal experiences shape legislators' attitudes towards financial regulation. And to answer that question, we consider US congressional legislators who have both the power to invest in stocks personally and the ability to vote on financial regulation at the federal level. Okay? Now, specifically, we ask the question, when these legislators' investments go bad through these firms committing fraud, how does this victimhood experience influence the voting patterns of these legislators? And the key phenomenon that we're interested in studying here is exactly this victimhood experience. It's this idea that being personally impacted or touched by fraud might make these legislators more likely to sympathize with and support regulation that tightens financial oversight. So before we get started, right, what do we mean when we say financial regulation? How do we define this? So in the paper, we consider financial regulation to be oversight of the financial services industry or financial reporting for public and private firms. What does that mean practically, right? We're looking at bills and amendments that are going to try to expand government oversight, maybe by opening up a new office or creating a new regulatory role. These could also be bills that require firms to make additional disclosures to the government, to investors, or to their customers. To give an example of this, I know it's very small to read on the slide, but this is a Cybersecurities Systems and Risks Reporting Act from 2016. This is an example of a bill in our sample that we consider to be tightening or increasing financial regulation. Why? Well, just from the title of the bill and the summary of the bill, this is a bill that was designed to expand Sarbanes-Oxley from 2002, which was a major regulatory overhaul after the scandals of the early 2000s, to actually require firms to also report on the quality of their cybersecurity systems. So because this is creating a new reporting requirement for firms, asking them to explain more about their cyber systems, we would consider this to be something that's increasing oversight, right, or tightening regulation. Now, what do we get from this study? How are we contributing to research that's already out there? So we're trying to contribute to two specific streams of research. The first is looking at personal experiences and legislator voting. So what we're doing here, in contrast to other studies, is we're conducting a within legislator analysis to see how legislator voting patterns shift in response to personal experiences. Right? So this stands in contrast to other studies that might look at some fixed demographic characteristic of that legislator and see whether or not they vote differently based on that. So I don't know if some of you guys have seen papers that look at like legislators that have daughters are more likely to vote in favor of reproductive rights. That would be an example of a characteristic that's fixed, right? It doesn't really change when they're in office, or it doesn't change that frequently, right? Here we're looking at the same legislator, something happens to them through their personal investments, and how does that shift their attitude towards financial regulation? The second stream of literature we're trying to speak to is looking at factors that shape voting on financial regulation. So there are prior studies that show that legislators are happy to vote for things that are going to protect their assets, right? So there's a paper that shows that legislators are more likely to vote in favor of a stimulus bill if they feel it's going to protect investments that they already have. Right? But what we're arguing, or what we're proposing in this paper, is that there may be some non-pecuniary, right, non-financial motives behind legislators' voting patterns. And we introduce this idea that the victimhood experience might actually make legislators want to try to help future potential victims of white-collar crime by increasing regulation. Right? So not just a vote for self, but maybe this is some kind of vote for justice. All right. Now, to state our research question formally, right, we're trying to determine, does legislators' personal exposure to financial fraud affect their support for financial regulation? Now, the steps we take to address this in the paper, right, we start by developing our hypotheses based on prior literature. Then we have to create our data. We use manually coded data to create our constructs for both that personal fraud exposure and our outcome, right, this supporting financial regulation. And finally, we do some empirical analysis that I'll share with you at the end. But here's the punchline up front. What do we find? We find in our sample that legislators are more likely to vote in favor of financial regulation after they have experienced personal fraud through their own investments. And what's really interesting is that when we look cross-sectionally, we find that this is more likely to happen when the political costs of voting based on your experiences are low. So for example, if you're a more experienced legislator, you have a longer tenure, right? And we also find that our results dissipate when the political costs of supporting financial regulation and voting on your experiences is high. So we find that these results dissipate when we look at legislators whose campaign support is more heavily financed by financial PACs. Okay. All right, so I'll start with hypothesis development. So based on prior literature, we have reasons to believe why fraud exposure may or may not produce any changes in the legislators' willingness to support financial regulation. On the one hand, there's a lot of literature showing that negative personal experiences can affect the way that you behave professionally. There are papers that show that financial analysts who live in states that are affected by hurricanes tend to release more pessimistic forecasts, even for firms that are completely unaffected by those hurricanes. It's an example of this kind of study. Other studies show that fraud exposure can make people more conservative when it comes to personal financial decision making. But on the other hand, in a lot of these studies, right, the affected party has a lot of agency or ability to translate their personal experience into the actions that they're taking at their jobs. In our setting, even though legislators may campaign based on personal beliefs, right, or things that happened in their life, once they get into office, they may find that they are really constrained by other kind of pressures that may limit their ability to vote purely based on what they believe, right? These pressures might be things like pressure to toe the party line, right, to vote in connection with the rest of your party, pressure to appease donors, or trying to get reelected, right? So that may dampen the effect of these personal experiences. There are also some studies, actually one of our prior studies, that shows that the effect of personal fraud exposure is dampened in settings when the affected party doesn't have a lot of agency to, or shouldn't be using a lot of discretion in taking actions. This is our paper looking at federal judges. All right, so if we believe that this is an open question, right, we don't know for sure if personal fraud exposure is going to lead to changes in legislators' voting patterns and their willingness to support financial regulation. How do we test it, right? And this is where we go to the data. And this is where it gets quite tricky, right? Because we've got two constructs that can be difficult to measure. We have a treatment, this victimhood experience, right? And we have this outcome of financial regulation. And to really get at those, it involves some pretty intense data collection, which I will summarize briefly for you here. And I'm going to start with our outcome variable of financial regulation. So how do we do this? So what we did is we started with proposed bills and amendments that were issued between 2004 and 2018. We searched the text of the bill metadata that you can get from govinfo.gov for categories that were related to our research questions, so things like finance and the financial sector, right? And this produced a sample of about 1,900 bills. Next, we went into the text and the summary text that is included in all of these bills to further tighten it to identify legislation that's more related to the construct that we're studying, this support for financial regulation as we've defined it in the paper. So we look for relevant keywords such as securities fraud or corporate exposure, and this narrows us down to about 499 bills and 152 associated amendments. And this is where it got really bad, right? You can do a text search, right? But how do we know that these bills and amendments are really talking about financial regulation? And even more than that, we need to know whether or not they are increasing financial regulation. Are they tightening financial regulation? So to do that, we actually hired pairs of law school students from a top US law school to read through the text of all of these bills and amendments and categorize for us whether or not they were financial in the way that we defined it in the paper, and whether or not these were truly increasing financial regulation. Right? And this left us with a sample at the end of the day of 21 bills and 75 amendments that fit our criteria and were ultimately voted on so that we can use those voting records. Right? All right. We also did a quick kind of smell test of our manual coding, and we find that in our sample, right, in general, Republicans were less likely to support financial regulation, and we also found that the more campaign support was coming from financial PACs, the less likely legislators were to vote in favor of financial regulation. All right. Victimhood experience was a little less manually challenging, but involved quite a bit of data work. So here we created our own database of fraud events from 3 different sources, the Stanford Securities Class Action Database, Violation Tracker, and AERs. And for each of the fraud events, we tried to identify the earliest possible date when the legislator could have learned about this fraud. Right? So you have a penalty date when the penalty was enacted, but we actually went back and tried to find the first public mention of each of these frauds. And then for each of those first public mentions, we calculated the abnormal stock return for that date, right, to estimate kind of, or try to identify what were the really kind of serious frauds that the legislator was likely to be aware of. Right? So we set our abnormal stock return, or we consider a serious fraud to be those that had less than negative 10% as an abnormal stock return on their announcement day. We combine this with data on the legislators' personal asset holdings, which we get from the Center for Responsive Politics. They have nicely cleaned all of this data for us, so we were able to identify about 67,000 legislator firm year holdings and confirm that the legislators actually held the fraud stock at the time of the fraud. Okay. We combine these and get about 130 exposed legislators over the sample, and we take their first fraud exposure and treat that as their treatment event. All right. Then we perform our analysis. So I can see I want to respect the time and respect your sanity and respect the size of that font. So I'm going to very briefly explain what's in the model. The outcome variable is an indicator for whether you vote to increase financial regulation. The independent variable of interest is a post-exposure variable. It says, was I exposed? And was I exposed to fraud before I voted on this? Right? And then we also include controls for their political party, whether or not they are a public firm investor, do you invest at all, whether you sit on financial committees or you are chair of a financial committee. And then we also include, I think, tenure and the percent of your last campaign contributions that came from financial PACs. All right. And what do we find? Well, for our first question, we do find this significant positive association between personal fraud exposure and a likelihood of voting to tighten financial regulation. And to put it in kind of economic terms, we find that the personal fraud exposure represents an increase from a baseline likelihood of supporting financial regulation of about 55% and raises it to about 62.4 to 62.9%. And what's super cool, and is kind of hard to see from where you're sitting, is when we look at the split between the parties, we find that this result is really being driven by the Republican subsample, which kind of makes sense since this was the group that was the least likely to vote in favor of financial regulation at baseline. Okay? All right. Then we do our cross-sectional tests. We say, okay, this is interesting. This fraud exposure seems to be creating some effect that's making these legislators want to support financial regulation, and in particular Republican legislators. When might this happen? Right? So first we look to see if this happens more when the political costs of responding to personal fraud exposure might be low. So we look at legislators with high tenure, because legislators with high tenure are more likely to be well established within their parties, sit on favorable committees, or have good relationships with their donors and constituents. And again, we find here that the results are stronger for these types of legislators, where maybe the political costs of voting based on a personal experience are lower. And then if we flip that and say, well, let's look at legislators for whom this would actually be quite costly for them, legislators that are financed a lot by financial PACs. Let's see if they are also willing to change their voting behavior in response to personal fraud exposure, and we find that these results disappear, right, when we look at those legislators who are heavily financed by financial PACs. Okay, I'm going to skip this additional analysis so we have time for questions. We conduct some robustness tests, which will bore you. So to wrap up, this is just a quick snapshot of a paper that we're very excited about. The early results that we have now suggest that legislators are more likely to vote for financial regulation after being personally exposed to fraud. And we're finding that these effects are stronger when the political costs of doing this are low, and that these effects dissipate when the political costs of doing this are high. With this paper, what we're trying to contribute is we're trying to use a within legislator analysis to show how legislator voting patterns are dynamic, that they can change over time and that they can be affected by these personal experiences. And then we're also trying to suggest this existence of a non-pecuniary or a non-financial motive that could perhaps drive some legislators to vote for justice. Okay, thank you so much.